What if I told you that most investors are making investing far more complicated than it needs to be? You can build serious wealth with just 3 ETFs. 3, not 30 stocks, just 3 ETFs. And that's important because most people aren't professional investors. They don't have time to research hundreds of companies or figure out which stock is going to win next. They have careers, families, businesses, lives. And if you're trying to pick the next Amazon or Nvidia, you're already making investing harder than it needs to be. Because building wealth isn't about finding the next winning stock. It's about owning great businesses, staying invested, and letting time do the heavy lifting. So let's take the guesswork out of it. If I were starting over today, here's exactly how I'd build that portfolio. I'll show you the actual ETFs I would use, the role each one plays, and how I would adjust the portfolio, whether you're 25, 45, or already approaching retirement. You'll see the exact allocations I would use at different stages of life and how one optional position can be used to customize the portfolio for your own goals and risk tolerance. Ready? Let's get into it. First up, what does the portfolio actually look like? At its core, it's built around 3 ETFs. Each one has a specific job. And together, they create a portfolio designed to grow with you through every stage of life. The first ETF is your foundation. This is the bedrock of the portfolio. The piece designed to give you broad exposure to the American economy and some of the world's most successful companies. The second ETF is your income and stability engine. Its job is to generate cash flow, provide resilience during market volatility, and help smooth out the ride when growth stocks inevitably hit turbulence. And the third ETF is your Growth Accelerator. This is where we lean into innovation, technology, and the companies driving future economic growth. Together, these 3 ETFs create a simple but powerful framework, a foundation for stability, an income engine for resilience, and a growth engine for long-term wealth creation. But here's where things get interesting. Most investors stop there. I don't. Because investing isn't one size fits all. A 25-year-old building wealth has very different needs than someone preparing for retirement, which is why I include what I call the flex position. This isn't a required 4th ETF. It's an optional position that allows you to customize the portfolio based on your goals, stage of life, and risk tolerance. For some investors, that might be international exposure. For others, it might be individual stocks. While some of you may prefer cash, bonds, or even a small allocation to alternative assets like crypto, commodities, or REITs. The core 3 stay remarkably consistent. The flex position adapts as your life changes. That's what makes this framework so powerful. Simple enough for a beginner, flexible enough for an experienced investor, and designed to evolve with you over decades, not months. Now, a portfolio is only as strong as the investments inside it. So let's take a closer look at each ETF, the role it plays, and why it earned a place in this portfolio. But before we do, if you're finding this helpful so far, do me a quick favor and hit the like button. It helps the channel tremendously and tells YouTube to show this video to more people who are trying to learn how to invest and build wealth. All right, let's reveal ETF number 1 and break down why it's the foundation of this entire portfolio. Every great building starts with a strong foundation, and investing is no different. If this portfolio were a house, the foundation ETF would be the concrete slab everything else sits on. Its job isn't to be the star of the show. Its job is to provide broad exposure to the American economy and create a stable base for long-term wealth creation. For me, that ETF is VOO. VOO is Vanguard's S&P 500 ETF. When you buy a single share of VOO, you're not buying one company. You're buying ownership in approximately 500 of the largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, Nvidia, JP Morgan Chase, Visa, Costco, and hundreds more. In other words, you're not betting on a single company. You're betting on American business. Over time, companies come and go. Leaders rise and fall. But the index adapts. As weaker companies drop out, stronger companies take their place, which means you're constantly invested in many of the largest and most successful businesses in the country. And that's really the beauty of index investing. You're not buying ticker symbols, you're buying ownership. Now, some investors prefer VTI, which owns virtually the entire U.S. stock market, and that's a perfectly reasonable choice. But for me, VOO strikes the right balance. It gives me exposure to America's largest, most established companies while remaining incredibly simple, low cost, and easy to understand. That's why VOO serves as the foundation of this portfolio. It provides diversification, long-term growth, and exposure to some of the most profitable businesses ever created. But a foundation alone isn't enough. We also need something that can generate income, provide resilience during market volatility, and help smooth out the ride. That's where ETF number 2 comes in. If VOO is the foundation of the portfolio, then ETF number 2 is the shock absorber. Because investing sounds easy when the market is going up. It's much harder when your portfolio drops 20, 30, or even 40%. That's when investors panic, when they abandon their strategy, and that's when long-term wealth-building plans fall apart. That's why the second ETF in my portfolio is SCHD. Now, SCHD is often called a dividend ETF, and while that's true, I think that description misses the bigger picture. SCHD isn't just about dividends, it's about quality cash flow, and it's about owning businesses that have already proven they know how to generate profits through good markets and bad ones. Companies like Coca-Cola, United Health, Verizon, Texas Instruments, businesses operating in completely different industries, but all sharing two important traits: consistent profitability and a long history of returning cash to shareholders. While growth ETFs focus on tomorrow's innovators, SCHD focuses on companies generating substantial profits today, companies that pay shareholders to own them. And that brings me to one of the biggest mindset shifts investors need to make. Wealth isn't just about what you own, it's also about what your assets pay you. Think about it this way. Most people spend their entire lives working for money. But truly, wealthy people eventually reach a point where their money starts working for them. That's where dividends come in. When companies inside SCHD generate profits, a portion of those profits is distributed to shareholders in the form of dividend payments. And if you're reinvesting those dividends, you're using those payments to buy even more shares, which then generate even more dividends, which buy even more shares. It's one of the simplest examples of compounding in action. Now, traditionally, many investors use bonds as the stability portion of their portfolio. And for some investors, particularly those in retirement, bonds may still have a role to play. But for investors who are still building wealth, I prefer SCHD because it gives me the opportunity to generate income while still participating in long-term market growth. In other words, I don't have to choose between growth and cash flow. I can have both. That's why SCHD serves as the income and stability engine of this portfolio. VOO helps me own America. SCHD helps me get paid while I do it. So far, we've built a strong foundation. VOO gives us broad exposure to the American economy. SCHD provides income, quality, and resilience. But if we're still in wealth building mode, we need one more thing: growth. That's where ETF number 3 comes in. For me, that ETF is SCHG. SCHG is a growth-focused ETF designed to give investors greater exposure to companies that are growing faster than the broader market. Think companies leading innovation, technology, artificial intelligence, healthcare breakthroughs, digital infrastructure, and the industries helping shape the future economy. Now, this isn't about chasing hype. It's not about trying to predict the next big thing. And it's certainly not about gambling on a handful of speculative stocks. It's about recognizing a simple reality. Throughout history, innovation has been one of the most powerful drivers of wealth creation. The companies that solve problems, increase productivity, and change the way we live and work often create tremendous value over time. SCHG gives us additional exposure to those businesses, and that's why I call it the Growth Accelerator. VOO already gives us growth, but SCHG allows us to lean a little harder into the areas of the market that have historically driven much of that growth. Think of it this way: VOO is the engine. SCHD helps smooth out the ride, while SCHG presses a little harder on the accelerator. Not because we're trying to get rich overnight, but because we're still building wealth. And when you have decades ahead of you, growth matters a lot. Now, could you use a different growth ETF? Absolutely. Some investors prefer QQQM, others prefer VUG. All three can serve a similar role inside the portfolio. The specific ETF matters less than the purpose it serves. And that purpose is simple: to increase your exposure to long-term growth. So now we have our 3 core positions: a foundation, an income and stability engine, and a growth accelerator. But investing isn't one size fits all. A great portfolio isn't just about what you own. It's also about how you put the pieces together. Because a portfolio designed for a 25-year-old should look very different from one designed for someone approaching retirement. So let's talk about allocation. Now that we understand the 3 core ETFs, the next question is, how much of each should you own? And the answer depends on one thing: time. More specifically, how much time you have before you'll need this money. Because a 25-year-old investing for retirement has very different needs than someone planning to retire in 5 years. That's why I don't believe in one-size-fits-all portfolios. The core 3 remain remarkably consistent, but the percentages change as your life changes. And before we talk about those percentages, there's one final piece of the framework you need to understand: the flex position. Most portfolios fail because investors keep adding things: more ETFs, more funds, more complexity. The flex position isn't an excuse to do that. It's a way to customize the portfolio without breaking it. Here are the 3 rules. Rule number 1, the core 3 stay intact: VOO, SCHD, and SCHG. Rule number 2, the flex position solves a specific need, not a random idea, not a hot stock tip, not something you saw on social media. A specific need: international diversification, additional income, capital preservation, or a small allocation to a higher risk opportunity. Rule number 3, the flex position stays relatively small. Because the goal isn't to reinvent the portfolio, it's to personalize it. The core 3 build wealth. The flex position fine-tunes the strategy. Now let's look at how I would allocate this portfolio at different stages of life. But before we jump into those allocations, if you're finding this video helpful so far, I'd really appreciate your support. Hit the like button, subscribe if you haven't already, and if you think this video deserves it, tap hype as well. Every one of these helps YouTube share this video with more people who are trying to learn how to invest and build wealth. All right, let's start with investors in their 20s through 40s. If you're in your 20s, 30s, or even your early 40s, this is what I call the wealth building stage. You still have one asset working in your favor that no investor can ever buy more of: time. And when you have time, you can afford to prioritize growth. That's why my allocation for this stage looks like this: 40% VOO, 20% SCHD, 40% SCHG. VOO remains the foundation. SCHD provides income, quality, and resilience. And SCHG gives us additional exposure to the companies driving future growth and innovation. Notice that growth receives a larger allocation here. That's intentional, because at this stage of life, you're not trying to preserve wealth. You're trying to build it. You still have decades before retirement. Decades for compounding to work, decades to recover from market corrections, and decades for great businesses to continue growing. That's why I believe younger investors should focus less on avoiding volatility and more on maximizing long-term opportunity. Because volatility is temporary, but time lost can never be recovered. Now, this doesn't mean you should take reckless risks. It doesn't mean chasing meme stocks. It doesn't mean gambling on the next hot investment trend. Remember, stop trying to find the next winner. Own the winners. That's exactly what the core three are designed to do. And if you choose to use a flex position during this stage, I would generally keep it focused on growth-oriented opportunities. That could include a small allocation to individual stocks, a modest allocation to cryptocurrency, or additional international exposure if that's important to you. Just remember the rules. The core three build wealth. The flex position fine-tunes the strategy. One quick note: where you hold these investments can be almost as important as which investments you choose. For example, whether you invest through a taxable brokerage account or a tax-advantaged retirement account can have a meaningful impact on your long-term results. The best choice depends on factors like your income, your tax situation today, and your goals for the future. But asset location is a topic big enough for its own video. So for now, focus on building the right portfolio first. Then we'll talk about which accounts are best for holding specific investments. Now, before we move on, there are two more pieces of the puzzle I think younger investors shouldn't overlook. The first is your emergency fund. If you're still building it, make that a priority. I generally recommend having at least 3 to 6 months of living expenses set aside in a high-yield savings account. Not invested, not chasing returns, just accessible when you need it. Because investing works best when you're not forced to sell during a market downturn. Your emergency fund gives you options. It helps you handle unexpected expenses, job loss, major repairs, or life's inevitable surprises without disrupting your long-term investment strategy. Think of it as the foundation beneath the foundation. Because before you can confidently invest for the future, you need to know today's emergencies are already covered. Once you've built that financial foundation, the next opportunity I would look at is a health savings account, or HSA. If you're eligible, it may be one of the most powerful wealth-building tools available. Why? Because it offers something incredibly rare: triple tax advantages. Your contributions may be tax-deductible. Your investments can grow tax-free. And qualified withdrawals for medical expenses can be tax-free as well. In other words, you can potentially avoid taxes on the money going in, the growth along the way, and the money coming out. That's why many investors quietly treat an HSA as a supplemental retirement account. And there's another reason I like HSAs. Medical costs are one of the fastest growing expenses in retirement. The reality is that many people spend decades building wealth but very little time preparing for the healthcare expenses that often come later in life. A major illness, surgery, or long-term health condition can quickly erode years of wealth you've worked hard to build. An HSA helps address both challenges at the same time. It gives you another tax advantage bucket for long-term investing while also helping you prepare for one of the largest expenses many retirees will eventually face. That's a powerful combination because building wealth isn't just about growing money, it's also about protecting it. And if you're eligible for an HSA, I would strongly consider funding it alongside this portfolio. Because choosing the right investments is important, but choosing the right accounts can be just as powerful. Now let's look at how the portfolio evolves as we move into our 40s and 50s. If your 20s and 30s were about building momentum, your 40s and 50s are about acceleration. For many people, these are their highest earning years. Careers have advanced, businesses have matured, income has increased, and hopefully, years of consistent investing have started to compound. But this is also the stage where many investors begin to panic. They're running retirement calculators, looking at college expenses, thinking about aging parents, wondering if they've saved enough, and suddenly they start questioning everything. Should I be more aggressive or conservative? Or should I move everything into cash? The answer is usually none of the above. Because while retirement may be getting closer, you still have something incredibly valuable on your side. Time. Many investors in this stage still have 15, 20, or even 25 years before retirement. That's plenty of time for great businesses to continue growing and compounding, which is why my allocation for this stage looks like this: 35% VOO, 30% SCHD, 35% SCHG. Notice what's changed. Growth is still important, very important. But we're beginning to place a greater emphasis on income and stability. SCHD moves from 20 to 30%. Not because we're abandoning growth, but because we're starting to think differently about risk. At this stage, the goal isn't simply to accumulate more assets, it's to build a portfolio that can continue growing while becoming more resilient over time. The foundation remains strong, the growth accelerator remains important, but the income and stability engine begins to play a larger role. Think of it this way. In your 20s and 30s, you can afford to be a little more aggressive because time can help you recover from mistakes. In your 40s and 50s, you're still building wealth. But now you're also protecting the progress you've already made. That's an important distinction because successful investing isn't about taking the most risk. It's about taking the right amount of risk for your stage of life. And if you choose to use a flex position during this stage, I generally prefer options that improve diversification or strengthen long-term planning. For some investors, that may mean adding international exposure through a fund like VXUS. For others, it may mean increasing contributions to tax-advantaged accounts or building a dedicated healthcare strategy through an HSA. The specific choice matters less than the purpose behind it. Remember, the core three build wealth. The flex position fine-tunes the strategy. And sometimes the smartest adjustment isn't adding another investment. It's making better use of the accounts available to you. One account, in particular, deserves serious attention during this stage of life. The Health Savings Account, or HSA. By your 40s and 50s, healthcare expenses are no longer a distant concern. Many investors are not only thinking about their own healthcare needs, but also those of their spouses, children, and aging parents. At the same time, these are often your highest earning years, which means they can also be your highest tax-paying years. That's what makes the HSA so powerful. If you're eligible, it offers a rare triple tax advantage, tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. No other account offers that combination. And unlike many people who use an HSA as a short-term spending account, I prefer viewing it as a long-term wealth-building tool. Invest it, let it grow, and give compounding time to work. Because one of the biggest threats to retirement wealth isn't market volatility, it's healthcare costs. The more prepared you are today, the more options you'll have tomorrow. But healthcare isn't the only risk that can derail a long-term financial plan. Life has a way of surprising all of us. Which brings me to one more thing I want investors in this age group to pay close attention to. Your emergency fund. In your 20s and 30s, an emergency fund helps protect you. In your 40s and 50s, it helps protect everything you've built. At this stage of life, financial responsibilities tend to multiply. Children, college expenses, mortgages, businesses, aging parents, and often higher monthly expenses across the board. That's why I generally recommend having at least 6 months of living expenses set aside in a high-yield savings account, money market fund, or short-term CD. Not invested, not chasing returns, just safe, accessible, and available when life happens. Because one unexpected expense shouldn't force you to interrupt a long-term investment strategy. Your portfolio's job is to build wealth. Your emergency fund's job is to protect it. Now, if your 40s and 50s were about acceleration, your 50s and 60s are about transition. Not from investing, not from growth, but from building wealth to preparing to live on it. For the first time, retirement is no longer a distant concept. It's becoming real. You can see it on the horizon. And that changes the way many investors think about risk. At this stage, the goal isn't to stop growing your money. The goal is to become more intentional about protecting the wealth you've spent decades building. That's why my allocation for this stage looks like this: 30% VOO, 40% S, CHD, 30% S, CHG. Notice what has changed. For the first time, the income and stability engine becomes the largest position in the portfolio. That's intentional, because as retirement gets closer, cash flow and resilience become increasingly important. Not because growth no longer matters, but because sequence and timing begin to matter more. A major market downturn is much easier to recover from when you're 30 than when you're 60. That's why SCHD now takes the lead. It continues to provide income, quality, and long-term growth potential while helping create a smoother ride as retirement approaches. VOO remains the foundation. SCHG remains the Growth Accelerator, but the emphasis begins to shift toward stability and income generation. Think of it this way. In your 20s and 30s, your biggest asset was time. In your 40s and 50s, your biggest advantage was your earning power. In your 50s and 60s, your focus begins to shift toward flexibility, the ability to adapt, the ability to weather uncertainty, and the ability to retire on your terms. Because retirement isn't built in the 5 years before you retire. It's built in the decades leading up to it. And by now, the goal is to make sure the portfolio you've built is prepared for what comes next. Okay, there's one more piece of the puzzle many investors overlook: liquidity. By this stage, retirement is no longer a distant concept. It's becoming visible on the horizon, which means protecting your timeline becomes just as important as growing your portfolio. That's why I consider an emergency fund non-negotiable. Ideally, you should have at least 6 months of living expenses sitting in a high-yield savings account, money market fund, or short-term CD. Not invested in the market, not chasing returns, just safe, accessible, and ready when you need it. Because one of the biggest mistakes investors make is being forced to sell investments during a market downturn to cover an unexpected expense. Job loss, a major home repair, a medical emergency, a family crisis. Those events are stressful enough on their own. The last thing you want is to compound the problem by selling long-term investments at exactly the wrong time. Think of your emergency fund as a financial shock absorber. Its purpose isn't growth. Its purpose is protection. Because the closer you get to retirement, the more valuable flexibility becomes. And finally, let's talk about one of the biggest threats to retirement wealth: healthcare costs. For many investors, healthcare becomes one of the largest expenses they'll face in retirement. And unlike many other expenses, it's also one of the hardest to predict. That's why I continue to be a strong believer in the Health Savings Account, or HSA, if you're eligible. The triple tax advantages don't become less valuable as you age. They become more valuable. Every dollar you contribute, invest, and allow to compound today can help reduce the pressure on your retirement portfolio tomorrow. And healthcare isn't the only concern. Long-term care is another expense many retirees underestimate. Whether it's in-home assistance, assisted living, or nursing care, these costs can quickly erode years of wealth you've worked hard to build. The good news is that planning ahead gives you options, and options are one of the greatest forms of financial security. Because at this stage of life, protecting wealth becomes just as important as building it. But eventually, protecting wealth is no longer enough. You also have to prepare to start living on it. That's why the final 5 years before retirement deserve a strategy all their own. At this stage, retirement is no longer a distant concept. It's becoming an upcoming reality. And that changes the conversation. The focus is no longer maximizing growth at all costs. It's making sure the retirement you've spent decades building is actually ready to support you. That's why my allocation for this stage looks like this: 40% VOO, 40% S, CHD, 20% S, CHG. Notice what has happened. The foundation and the income and stability engine now carry equal weight. That's intentional, because as retirement approaches, dependability becomes just as important as growth. VOO continues to provide broad exposure to the American economy and many of the world's most successful companies. SCHD continues to generate income while providing quality and resilience. And SCHG remains in the portfolio because retirement doesn't eliminate the need for growth. In fact, many retirees will spend 20, 25, or even 30 years in retirement. Your money still needs to work. It still needs to grow. But growth no longer drives the strategy. Preparation does. At this stage, you're not trying to hit home runs. You're trying to build confidence that your portfolio can weather a market downturn, confidence that it can generate income, confidence that it can support the lifestyle you've worked so hard to create. Think of it this way. In your younger years, investing was about accumulation. Now it's about preparation. Preparation for the next chapter of life. Preparation for market uncertainty. And preparation for the day your investments begin working harder than you do. Because the goal isn't to arrive at retirement with the largest possible portfolio. The goal is to arrive prepared. Ask yourself a simple question. Could my retirement plan survive a major market downturn? Because sooner or later, one will come. Not because something is wrong, but because that's how markets work. The investors who struggle most in retirement are often the ones who assume everything will go according to plan. The investors who succeed are the ones who prepare for the unexpected. That's why I encourage people approaching retirement to stress test their plan. What happens if the market falls 20%? What happens if inflation stays elevated? What happens if healthcare costs rise faster than expected? What happens if you live longer than you planned? You don't need perfect answers, but you should know how your plan responds, because confidence doesn't come from optimism, it comes from preparation. Now there's one final strategy I want you to consider before retirement. Reducing your fixed expenses. The less money you need each month, the more flexibility you create for yourself. That may mean paying down high-interest debt, eliminating credit card balances, paying off a vehicle, or even entering retirement with a smaller mortgage than you have today. Retirement isn't just about building assets, it's also about reducing obligations. Every monthly bill you eliminate is one less demand on your future portfolio. And that's powerful, because financial freedom isn't determined solely by how much money you have. It's also determined by how little money you need. The lower your fixed expenses, the more resilient your retirement plan becomes. Now, maybe you're watching this and thinking, that's great, but I'm 45, 55, or even 65, and I have little or no savings, little or no investments. Maybe life got in the way. Maybe you were focused on raising a family, building a business, paying off debt, recovering from a divorce, helping your children, taking care of aging parents, or maybe nobody ever taught you this stuff. First, let me say this. You are not alone. Millions of Americans reach their 40s, 50s, and even 60s before realizing they haven't saved enough for retirement. And while that's not ideal, it doesn't mean all hope is lost. What you cannot afford to do is panic, because panic leads people to make some of the worst financial decisions of their lives. They start chasing hot stocks, trying to double their money overnight, taking risks they don't fully understand, and confusing speculation with investing, because the fastest way to fall further behind is to take risks you can't afford to take. The goal is not to catch up overnight. The goal is to start. Because the truth is, wealth isn't built in a single year. It's built through consistent action repeated over time. And the good news is that you still have more control than you think. You can increase your savings rate, take advantage of catch-up contributions, reduce unnecessary expenses, delay retirement by a few years if necessary, and most importantly, start investing consistently. So where should you start? Simple. Start with the core three. You don't need a complicated portfolio. You don't need 20 ETFs. And you certainly don't need to start taking excessive risks trying to make up for lost time. If I were starting from scratch later in life, I would still begin with the core three. The same framework we've been discussing throughout this video, just with a slightly more balanced allocation: 40% VOO, 40% SCHD, 20% SCHG. Why? Because it gives you broad market exposure, income generation, and continued growth potential without forcing you to bet everything on high-risk investments. The goal isn't to get rich overnight. The goal is to build a portfolio that can realistically support your future. Let's put this into perspective. Imagine you're 50 years old and starting from scratch. Using this portfolio and assuming an average annual return of approximately 14.8%, if you invested just $125 per week, that's about $500 per month, you could potentially accumulate more than $325,000 by age 65. Increase that to $250 per week, or about $1,000 per month, and you're looking at roughly $650,000. At $500 per week, or about $2,000 per month, you could potentially accumulate nearly $1.3 million. Now, these aren't guarantees. They're simply examples designed to show the power of consistent investing over time. That's not from finding the next NVIDIA, not from day trading, not from gambling on crypto, just consistent investing, month after month, year after year. Will your portfolio look different from someone who started at 25? Of course, but that's not the comparison that matters. The comparison that matters is this. 15 years from now, wouldn't you rather have a portfolio worth hundreds of thousands, or even more than $1 million? Or still be wishing you had started today? Here's another reason why starting today matters. Imagine three investors. They all retire at age 65. They invest in the same portfolio. They earn the same average return of roughly 14.8% per year. The only difference is when they start. One starts at 40, one starts at 50, and one waits until 60. Look at what happens. Time doesn't just matter, time changes everything. That's why the goal isn't to find the perfect investment. The goal is to start as early as possible and stay consistent. Because compounding rewards action, not perfection. Remember, the best time to start investing was 20 years ago. The second best time is today. Don't waste time focusing on what you should have done. Focus on what you can do now. Because your future doesn't care when you started. It cares what you do next. And whether you're 25 or 55, the principles remain the same. Own great businesses. Invest consistently. Stay disciplined. And give compounding as much time as possible to work in your favor. Because progress will always beat regret. And the sooner you begin, the more powerful that progress becomes. Because one day, your portfolio stops being something you build and becomes something you live on. Throughout this video, we've talked about age, your 20s, your 40s, your 50s, and even the 5 years leading up to retirement. But now I want to challenge a common assumption. Retirement isn't an age, it's a strategy. Because I've met people who were financially independent at 40, and I've met people still working at 75. The calendar doesn't determine retirement. Your finances do. Retirement begins the moment your paycheck stops and your portfolio takes over. That's the real transition. And when that happens, the purpose of your portfolio changes. For decades, your investments were helping you build wealth. Now they're helping support your lifestyle. That's why one of the biggest myths about retirement is that you stop investing. You don't. Your portfolio still has a job. The mission simply changes. Instead of maximizing growth, you're now focused on income, stability, preserving purchasing power, and keeping pace with inflation. Because retirement isn't the end of investing, it's simply a new phase of it. And regardless of whether you retire at 40, 60, or 67, one principle remains the same. You need a plan for market downturns, because markets can and will decline, sometimes for months, sometimes for years, and the last thing you want is to be forced to sell investments at the exact moment they're down. That's why I believe every retiree should have a financial airbag. 3 years of living expenses held completely outside the market, money market funds, high-yield savings accounts, short-term CDs, safe, accessible, and ready when you need it. Think of it as your retirement runway. When markets get turbulent, this cash buffer gives your portfolio time to recover without forcing you to sell investments at a loss. Because the goal isn't just to retire, it's to stay retired. Let's look at 3 examples and see how that strategy changes depending on when retirement begins. But first, if you're enjoying the video, I'd really appreciate it if you'd hit the like button, tap hype, and subscribe. Every one of those helps the channel grow and allows me to keep creating content like this. All right, let's put all of this into practice. We'll start with the most traditional retirement scenario. You're 67 years old, you've finished your career, Social Security has begun, and now your portfolio is helping support your lifestyle. Let's assume you've accumulated a retirement portfolio of roughly $1.5 million. And let's say your annual spending goal is around $70,000 per year. Social Security may cover part of that. Maybe $20,000, maybe $30,000. The exact number isn't important. The point is that your portfolio no longer needs to do all the heavy lifting by itself. Let's put some numbers to that. Say Social Security covers about $24,000 a year. That means your portfolio only needs to reliably provide the remaining $46,000. Now remember the financial airbag or emergency fund we talked about earlier? This is where it becomes incredibly valuable. Think of it as 3 years' worth of living expenses sitting safely on the sidelines. In this example, that works out to roughly $140,000 held outside the market. Money market funds, high-yield savings accounts, or short-term CDs. Why? Because markets don't move in straight lines. Some years will be fantastic, others won't. And the last thing you want is to be forced to sell investments during a downturn just to cover living expenses. Let's say the rest of your portfolio, about $1.36 million, is still invested. Then, after enduring a year or two of down markets, the tide finally turns. Because eventually, markets recover. They always have. If your remaining $1.36 million portfolio grows by 15%, that's more than $200,000 in gains. You could withdraw your $46,000 for the year, rebuild your financial airbag, and still finish the year more than $100,000 ahead. That cash reserve gives your portfolio time to recover. It gives you flexibility. And perhaps most importantly, it gives you peace of mind. The rest of the portfolio can remain invested and continue working for you. Here's how I'd structure it. 40% VOO, 50% SCHDs, 10% SCHG, plus 3 years of living expenses held outside the market. Notice that growth hasn't disappeared. It's simply no longer the priority. Income and stability now take the lead. And if you've been funding an HSA throughout your working years, this is exactly the stage it was designed for. Those tax-free dollars can now help cover healthcare expenses without placing additional pressure on the rest of your retirement portfolio. Because at this stage, the goal isn't to maximize returns. The goal is to generate reliable income, preserve purchasing power, and maintain the lifestyle you've spent decades building. Remember, you don't retire from investing. You retire into a different investing strategy. Now, let's look at a different situation. What if you retire at 60? You're no longer working, but Social Security hasn't started yet. That changes the math. Because now your portfolio may need to cover your entire living expenses for several years before those benefits begin. If you've been contributing to an HSA throughout your working years, this is where that planning begins to pay off. And that's also why I still believe the financial airbag becomes critical. 3 years' worth of living expenses held somewhere safe and accessible gives your portfolio time to recover during market downturns without forcing you to sell investments at the worst possible moment. In this example, your portfolio now needs to provide the full $70,000 each year, while your financial airbag grows to approximately $210,000, enough to cover 3 years of living expenses outside the market. If you haven't built up your emergency fund up until this point, that leaves about $1.29 million still invested. Now imagine, after a 2-year downturn, the market rebounds by 15%. Your remaining portfolio grows by roughly $193,000. Of course, not every year will look like this. But that's not the point. The point is that you've given yourself time. Time to let your investments recover. Time to avoid selling during market downturns. And time to continue compounding while you wait for Social Security to begin. Unlike our 67-year-old retiree, though, you still have a much longer runway ahead of you. Social Security may still be 5, 6, or even 7 years away, and retirement itself could last 30 years or more. That means growth still matters. In fact, it matters more than people realize. Because inflation doesn't retire when you do. Your expenses will continue to rise. Healthcare costs will continue to rise. And your portfolio needs to keep up. That's why I would structure the portfolio like this. 40% VOO, 45% S, CHD, 15% S, CHG, plus 3 years' worth of living expenses held outside the market. Notice that the Growth Accelerator receives a slightly larger allocation than in the traditional retirement example. That's intentional. We're trying to strike a balance. Enough income and stability to support today's lifestyle. Enough growth to help support tomorrow's. Because retiring at 60 isn't the same as retiring at 67. Your portfolio may need to carry more of the load for a longer period of time. That's why this stage isn't about becoming more aggressive. And it isn't about becoming more conservative. It's about becoming more intentional. The goal is to create a portfolio that can continue generating income today while still growing enough to support you decades into the future. Because retirement isn't just about leaving work. It's about making sure your money can continue working long after you do. There's one final retirement scenario I'd like to discuss. What if you're 40 years old and financially independent? No paycheck, no traditional retirement age, just enough assets to support the lifestyle you've chosen. Let's assume you've accumulated a $5 million portfolio and want to generate approximately $150,000 per year to support the lifestyle you've built. You enjoy traveling, dining out, pursuing hobbies. Maybe you've even started a passion business or consulting practice because you want to, not because you have to. Most people think retiring early means taking less risk. I think it means managing different risks. Because someone retiring at 65 may need their portfolio to last 20 or 30 years. A 40-year-old retiree may need it to last 40 or even 50. That's an entirely different game. And it changes the way we think about retirement. The first thing I would tell someone retiring this young is this. Your plan has to be built on self-sufficiency. If you're only 40 today, I wouldn't build a retirement plan assuming Social Security or Medicare will look exactly the way they do now. Benefits could change, eligibility ages could shift, or the programs may simply look very different decades from today. If those benefits are available when you eventually qualify, that's wonderful. But your retirement shouldn't depend on them. It should be able to stand on its own. Because confidence comes from knowing your plan works, even if government benefits eventually become smaller than expected. But that's only the first challenge. The second is what I call the bridging gap. Unlike someone retiring at 65, you have decades before you reach Medicare. And depending on where your money is invested, you may also have years before you can access certain retirement accounts without penalties or qualifying exceptions. That means your retirement income may need to come primarily from taxable brokerage accounts, Roth IRA contributions, where applicable, or other IRS-approved strategies designed for early retirees. In other words, you aren't just funding retirement. You're building bridges from age 40 to age 60, and then from age 60 to Medicare, before many of the traditional retirement benefits even begin. That's one of the reasons taxable brokerage accounts become so valuable for someone retiring this early. Now, most people assume the biggest threat to retiring at 40 is a market crash. It isn't. The bigger risk is that your portfolio stops growing while you still have another 40 or 50 years to fund. Inflation doesn't stop simply because you retired. Your expenses will continue to rise, healthcare costs will continue to rise, travel becomes more expensive, housing becomes more expensive, nearly everything becomes more expensive. Which means becoming overly conservative too early can be just as dangerous as taking too much risk. But that doesn't mean investing recklessly either. One of the biggest risks early retirees face is something called sequence of returns risk. Think about it this way. It's not just how much your portfolio earns, it's when those returns occur. If the market falls dramatically during your first few years of retirement while you're simultaneously withdrawing money to pay your bills, you're selling investments at depressed prices. those shares are gone forever. They can no longer participate in the recovery. The exact same market decline 20 years later is often far less damaging because your portfolio has already benefited from decades of compounding. That's why protecting those first several years of retirement is so important. Here's how I would structure the core portfolio: 35% VOO, 30% SCHD, 35% SCHG, plus a multi-year cash reserve held completely outside the investment portfolio. Unlike someone who's still working, your portfolio is now your paycheck. That's why I would maintain several years of planned living expenses outside the market, not because I'm trying to predict recessions, and not because I think cash outperforms stocks, but because that reserve gives you the flexibility to continue paying your bills without being forced to sell investments during prolonged market declines. Sometimes the greatest advantage cash provides isn't the return, it's the time. Time for your portfolio to recover, time for compounding to continue, and time to avoid making emotional decisions during difficult markets. Now let's talk about something I would also consider if I retired this young, the flex position. Throughout this video, we've talked about keeping the core portfolio simple. That doesn't change. The core portfolio remains exactly that, the core. But if you've accumulated several $1,000,000 by age 40, there's a good chance your wealth extends beyond publicly traded stocks. This is where I might allocate a relatively small portion of my overall net worth to investments with a specific purpose. Things like real estate investment trusts, international markets, private equity, venture capital, or even a carefully sized allocation to cryptocurrency, if it fits your risk tolerance and long-term investment plan. The key is that these investments complement the core portfolio. They don't replace it. The foundation remains exactly the same. The flex position simply gives you room to customize without compromising the long-term strategy. One thing I haven't covered in this video is where I would actually hold each of these ETFs. Should VOO go in a brokerage account, a Roth IRA, a traditional IRA, a 401k, or an HSA? Because building a great portfolio isn't just about what you own, it's also about where you own it. That's exactly what we'll cover in my next video, the ABCs of retirement accounts. We'll walk through brokerage accounts, traditional and Roth IRAs, 401ks, HSAs, and other retirement accounts, so you'll know exactly where each piece of this portfolio belongs, and, more importantly, why. But there's one more challenge every early retiree has to solve. Healthcare. Unlike someone retiring at 65, you're potentially 25 years away from Medicare. That means private health insurance becomes one of the largest ongoing expenses you'll face. On screen, you'll see current estimates for private health insurance premiums for a 40-year-old purchasing coverage on the individual market. Today's premiums can already cost hundreds of dollars per month for a single individual, and often much more for couples and families. Those costs also tend to increase as you age, which is exactly why I would continue prioritizing an HSA whenever I'm eligible, not as a spending account, as an investment account. Because every dollar invested inside an HSA has the potential to grow tax-free for decades. And when those healthcare expenses eventually arrive, you'll have a dedicated pool of assets specifically designed to help cover them. That's one of the reasons I often call the HSA the stealth retirement account. Most people overlook it, but for someone retiring this young, it can become one of the most valuable tools in the entire financial plan. Because retiring at 40 isn't about reaching the finish line. It's about building a financial system that's capable of supporting you for another 40 or 50 years. A portfolio that continues growing, a cash reserve that provides stability, a tax strategy that creates flexibility, and a healthcare plan that's prepared for the future. Retiring at 40 isn't about having enough money to stop working. It's about having enough freedom to decide whether you ever have to again. So, by now, some of you may have noticed something missing from this portfolio: bonds. After all, for decades, investors have been told some version of the same rule. The older you get, the more bonds you should own. And for a long time, that advice made sense. Bonds were designed to provide stability, income, and a smoother ride when stocks became volatile. So if bonds have been a cornerstone of retirement planning for generations, why aren't they part of this portfolio? The answer isn't that bonds are bad, and it certainly isn't that bonds never belong in a portfolio. The answer is that investing is about trade-offs, and every asset comes with strengths and weaknesses. Let's start with the good. Bonds can absolutely reduce portfolio volatility. They can provide income, and in certain market environments, they can help cushion the impact of stock market declines. But you also need to understand how bonds really work. When interest rates fall, your high-yield savings account or money market fund usually starts paying less. That 5% yield you loved may fall to 4%, then 3%, maybe even lower. But bonds behave differently. When interest rates fall, existing bonds paying higher rates suddenly become more attractive. As a result, the value of those bonds often rises. And if you already own a bond ETF, you may benefit from that price increase. Sounds like a win, right? Well, yes and no, because while existing bondholders may benefit, new investors face a different reality. New bonds are now being issued at lower rates, which means future income may be lower. And if inflation remains elevated, those lower yields may not even keep pace with rising living costs. That's why it's important to understand what bonds really are. They're not a free lunch. They're a trade-off. Stability over growth, comfort over compounding. And that's one of the reasons I chose SCHD as the income and stability engine in this portfolio. Not because SCHD is safer than bonds, and not because it will outperform bonds in every market environment, but because I wanted an asset that could provide income while still offering the potential for dividend growth and long-term capital appreciation. In other words, I wasn't just looking for stability. I was looking for stability that could continue growing over time. That's a very important distinction, because inflation never stops, and neither should your portfolio's ability to grow. Now, does that mean you should never own bonds? Of course not. If bonds help you sleep at night, if they match your risk tolerance, or if they fit your personal retirement plan, then they may absolutely have a place in your portfolio. Remember, investing isn't about finding the perfect allocation. It's about building a portfolio you can stick with through good markets and bad. For me, SCHD fills the role that many investors traditionally assign to bonds: income, quality, resilience, and the potential for continued growth. That's why it's one of the 3 pillars of this framework. Not because bonds are wrong, but because I believe there may be a better alternative for many long-term investors. All right, let's bring everything together. At the beginning of this video, I told you that most investors make investing far more complicated than it needs to be, and hopefully, by now, you can see why. You don't need dozens of ETFs. You don't need to constantly chase the next hot stock, and you don't need a portfolio so complicated that you can't explain it to someone else. You need a framework you can understand, a framework you can stick with, and most importantly, a framework that can evolve as your life evolves. That's exactly what this portfolio is designed to do. The foundation, VOO, the income and stability engine, SCHD, the Growth Accelerator, SCHG, 3 core ETFs. One simple framework. and then when needed, a flex position to personalize the strategy without breaking it. Because while life changes, the principles don't, and neither do the core three. The percentages may change, the allocations may change, but the foundation remains remarkably consistent. Let's look at the progression one last time. 20 to 40, build wealth, 40% foundation, 20% income, 40% growth, 40 to 50, accelerate wealth, 35% foundation, 30% income, 35% growth, 50 to 60, protect and prepare, 30% foundation, 40% income, 30% growth, 5 years from retirement, 40% foundation, 40% income, 20% growth. And that same framework continues into retirement. Whether you're retiring at 67, retiring early at 60, starting later than you planned, or pursuing financial independence at 40, the strategy may look different, but the framework doesn't. Your timeline changes, your priorities change, and your allocation changes with them. But the core three remain. Notice what never disappears. VOO never disappears. SCHD never disappears. SCHG never disappears. Only the percentages change. Because the core three build wealth. The percentages adapt to your life. And that's really the lesson I want you to take away from this video. Successful investing isn't about predicting the future. It's about owning great businesses, investing consistently, staying disciplined, and giving compounding enough time to do what it does best. Because the goal was never to collect ETF shares. The goal was never to obsess over market headlines. The goal was never to have the biggest portfolio in the room. The goal is freedom. The freedom to spend more time with your family. The freedom to pursue the work you love. The freedom to retire when you're ready. Or perhaps even before you're ready. Because money is the tool. Freedom is the goal. Never confuse the two. Now, if you've made it all the way to the end of this video, first of all, you're officially my kind of person. So go ahead and hit that like button, subscribe to the channel, and then tell me in the comments, which stage are you in, and what does your portfolio look like right now? And don't clean it up for me. If you've got 7 ETFs doing the job of 3, I want to hear about those too. We're all figuring out what works for us. And I have a feeling we're going to have some very interesting conversations in the comments. And remember, whether you're 25 or 55, whether you're investing your first $100 or managing a 7-figure portfolio, you are not too late, you are not alone, and you belong here. I'll see you in the next video.